Where does investing end and gambling begin? From premium bonds to meme stocks to deep out-of-the-money options, today's markets are full of bets that look a lot like lottery tickets. The line between rational risk-taking and pure chance has never been blurrier.
So what really separates a calculated investment from a coin flip? And in today's dumb question of the week, are boring stocks better? All right, let's get into it. So, Romin, there are a lot of similarities, on the face of it, between investing and gambling. You're putting money at risk for an uncertain return and hoping for the best. So where do we draw the line? Now, I know you love investing, clearly, but you hate gambling, don't you?
Yeah, I do. And people find it very difficult to tell the two apart. Partly, I think that's because of the messaging, but also because of education. But let's try in this episode to make it really clear so that when you're doing one or the other, you'll be able to look at your behavior, your own behavior, and say, yeah, this is gambling, this is investing.
But I wondered, is it even one or the other? Is it not more of a spectrum?
It is a spectrum, I think, but by your physiological reaction, and we'll come on to this, you should be able to tell which it is. So let's just start off with the basics, right? So what's the difference between gambling and investing? Well, I think the big difference is the payoffs, but also the probabilities of those payoffs. If you're doing gambling, what you're really going for is a low probability, very high payoff. Whereas if you're going for investing, you've got a reasonable probability of generating a reasonable return. And you do that over a longer period of time. So time is the other aspect of this. If you're doing gambling, you want a quick buck. If you want investing, well, you're in it for the long term.
Can I drill into that slightly? Because I kind of agree with you on top level terms, but there might be something that's disguising. So for me, it's all about expected value. And with investing, you expect positive expected value, positive EV. Like the sum total of investors should be making money. You as an individual might lose money, but overall people make money. Whereas with gambling, if you aggregated up all the people placing bets, there's negative expected value. The house always wins in aggregate. For me, that's the first key difference.
And that's key to the industry. I mean, the reason why we've got such an immensely powerful gambling lobby in the UK and such a huge gambling lobby is that for centuries, they've convinced people that this is a kind of fun thing to do, that it's kind of cool to gamble, and they've become immensely wealthy off the back of it.
Because the other point you made about kind of the distribution of returns, like gambling is more like you'll place a bet with a possibility of a huge payoff, but most probably you'll lose most or all of your stake. I agree, that is often the characteristic of gambling. But there are things that I would class as investing, which have a similar thing. Like you could look at venture capital, where they place a lot of bets. Most will fail. Most of those companies will go bankrupt. But some will turn into the next Google or Facebook and pay for all the rest. But because they're diversified, the idea is in aggregate, that VC firm is investing, not gambling. But it's kind of blurring the lines, right?
Yeah, and there's always a chance, even with the VC company, that they're not going to have that big payoff. And that because they haven't got enough bets in the game, they're not going to succeed as a company. So always be sure that whatever you're investing in has that reasonable chance of success. And the reason why I'm always banging on about index funds is because for most people, that's going to work. I mean, I could talk about microcaps. I love microcaps. I love these kind of speculative investments just for fun. But if I were to talk about that on my YouTube channel, then I'd be misleading a lot of people because they're unlikely to win. I think the other point about investing is it has a societal impact. If you buy the stocks of a company, or if you buy its bonds, or if you buy a government's bonds, that money is then being piped into something which is itself productive and may generate future cash flows or benefit the economy. Whereas if you're gambling, really the only people that are going to benefit from that are the people who are on the other side of the trade.
Yeah, you are, in a sense, benefiting the economy of the Cayman Islands when you're gambling or wherever it might be. But yeah, I kind of agree with you. There is that distinction, isn't there, of the impact of the money. So when you're investing, usually there's some kind of underlying cash flow or productivity, or even just like a transfer of risk between two parties, which is doing something intentionally. Whereas if you're literally putting money down on a roulette wheel, that's helping nobody.
And again, this is a continuum. For example, I had one client who has an incredibly elaborate betting system for horses, and he wanted me to look this over. And he developed this over the course of his entire life, and it was pretty successful.
Yeah.
I've got no idea about betting on horses. So, I did my best to look at what the probabilities were and try to help him. But he pretty much nailed this system.
Why would he come to you for help? Like, notoriously someone who hates gambling and has never been on a horse in their life.
I did a lot of riding as a kid. I used to love riding.
Did you?
Yeah.
So much you never tell us, Romin.
Actually, my favourite bit was grooming the horses, putting oil on their hooves, cleaning them out, and kind of brushing them down. I used to love that.
You're a little stable boy.
I was.
But anyway, I guess there is kind of an interesting point here about how things blur the line. Because for most people, betting on horses is clearly gambling, right? But there are some professional gamblers who might have an edge and genuinely have a positive expected return over the long term betting on horses or playing poker, where there is kind of a skill element, or at least theoretically it's possible to have a skill element. Certainly in poker, over the long term, you play millions of games, the best player should take the money. So it might not be investing, but it's not pure luck.
And the clue there is that if these people do exist, usually the gambling companies will try and stop them from betting because they know that the odds are now shifted against the house, which clearly they can't do profitably.
So what I'm really interested in, Romin, is this grey zone between the two extremes, which you might call lottery ticket investments. So by investments, we might mean, yes, the expected value for everyone together is positive, but they're lottery ticket-like in the fact that the distribution is heavily skewed to this low probability, high payoff event.
And if you're a statistician, the difference between these two ways of looking at it is the median outcome and the mean outcome. Now, in expectation theory, when you look at the expected return, you look at the probability of each outcome and multiply by the payoff, and then average that over the entire distribution. Now, if you have really high payoffs, and I'm here talking about stupendous payoffs, that's going to massively skew the outcome if you look at the expectation. If you look at the median outcome, well, that's notoriously insensitive to these outliers. It focuses on average luck. And for most of us, we have average luck. We think we've got more than average luck. Most people think they're above average drivers, right?
Yeah.
But we don't. And I think that's the key point. If you had an infinite number of lives to live, then yeah, you'd earn the expected return. But if we've just got one life to live, a finite set of trials in order to win the lottery, say, well, then the odds are massively skewed against you, and you should be looking at the median payoff.
So if you're a Buddhist and you believe in reincarnation, you should play the lottery. But other than that, you shouldn't. And Romin, a big counterpoint here is it could be you, right? Don't forget that. It could be you. But anyway, I feel like I've known you long enough, Romin, to feel that very shortly, we're going to get a little bit of a rant about premium bonds. Am I right?
You're absolutely right.
Let's use it as a case study, though.
Okay, so let's take the most boring investment you could possibly have, government bonds. Now, I love them because of the certainty. You pay 100 today, you get paid 4% in £2 payments every year, and then at some point in the future, you get your £100 back. Brilliant. Completely predictable. You know what the yield is on the day you buy it. And if you hold it to maturity, there's a lot of certainty in that investment. So how are you going to convert this really boring investment into something which is gambling? Well, you probably guessed it. You change the payoff. What you do instead of paying that guaranteed coupon is massively skew the payoff by paying some people a huge amount of return and some people, most people, nothing at all. Now, that's called a premium bond if you're not familiar with it. And you also kind of create an incentive, which is that it's tax-free. And of course, it's backed by the government, just like a government bond would be. But is that an investment or gambling? Well, it's gambling because of the payoff.
Is it though? The expected return in aggregate is positive.
Yeah, again, if you were going to live for 1,000 years, or if you could get reincarnated, it might be worth considering. But the probability of getting that huge payoff is just vanishingly low.
But your stake is not at risk though, which is often what we think about in gambling, is that you're going to lose money. Whereas with a premium bond, but in nominal terms, you're not going to lose money. There's going to be inflation eroding it over time. So you're losing a little bit each year if you don't win. But the average return is positive and sort of in line with cash savings accounts, say.
That's not the way I see it. The way I see it is that essentially you're giving up certainty in terms of income. So in terms of opportunity cost, that's what you're doing. You're not putting your capital at risk because it is guaranteed by the government. So it is safe in that sense. But why not earn that income for certain? Because that's what you're trading off. Certain coupon income with zero income on average. And when I'm talking about on average, here I'm talking about the median outcome.
For one individual premium bond.
Well, even if you have the maximum stake, which is £50,000 worth of these premium bonds, you're almost certain to win a prize every month. However, you're very unlikely to win the really large payoffs. In fact, all that happens is you approach the average payoff, which is slightly lower than it would be for a standard UK gilt. Currently, it's about 3.6%.
That's why they sell premium bonds, right? It's cheap financing for the government.
That's exactly why. And it's kind of cynical, I think, on their part. They're just exploiting our willingness to gamble and our desire to gamble in order to generate cheap funding for the government itself, which is naughty, I think.
Nah, it's kind of harmless, really. In the great scheme of evils, premium bonds are not up there for me. But it's interesting they have that cap, though. Do you think that's just to stop people sort of draining the banking system because they love gambling so much and buying too many premium bonds?
It's interesting. I don't know why there's a cap. That would be my guess, because maybe they think it would starve the banking system of deposits. Because if that happens, obviously, that's going to be a problem for lending. And that itself slows down the economy.
Yeah, it's interesting. Every time there's a sort of competing product to savings accounts and bank deposits, the regulators are always really nervous about like how much money are people actually going to pull out of the banks and put into these things. We see it at the moment with this consultation on stablecoin regulation in the UK. If you read that documentation, the Bank of England is again going to put in caps of how much people can hold in sterling stablecoin because they don't want to risk a run on the banks.
Which is understandable. I think that is their job. They exist to avoid these systemic risks. And so that's absolutely sensible from their point of view.
But from your point of view, Romin, caps are necessary. You're not ever going to buy a premium bond, are you?
Well, if I'd used up all of my ISA, all of my SIP in a given year, maybe I would. But if I did, I'd have to buy at least £1,200 worth.
Why is that?
I've made a video about premium bonds and I had to do lots of Monte Carlo simulation in order to really feel that I understood it. Now, there's a kind of two-stage process where the prizes are allocated. They've got this kind of quantum computer, which first of all works out which lottery tickets have won a prize. And then there's a second stage where they allocate the prizes themselves. So the first stage is pretty simple to work out the probabilities. It's just a binomial distribution. And in a given year, in order to have a 50-50 chance of winning at least one prize, you have to have at least 1,200 invested, because the odds of winning a prize are about 22,000 to 1.
And for you, you wouldn't touch it unless the probability was more than 50%? That's just a random number in your mind?
Yeah, because that's the kind of gateway to success, if you like. And it's kind of nice to think, well, I've got a 50-50 chance of winning something this year. But then will you go on to the next stage, which is to draw the £1 million payoff? Well, it's vanishingly unlikely that you will. But beyond that investment of 1,200, what you start to do is to approach the average rate of return, which is that 3.6%. And of course, that does vary over time. That's as we record this episode.
Okay. From now on in this episode, Romin, my goal is to convince you to buy some sort of gambling investment. So at the moment, as you said, the average return on premium bonds is going to be 3.6%. But that's skewed massively because there's these £1 million prizes. And you're not interested in that, really. You don't think you're lucky. You think you're going to get the median. Who cares if a few people are getting rich? Would you change your mind if instead of 1 million for those top two prizes, it was 100 million? Now, I don't know, I haven't done the maths. Let's say it pushes the average return up a bit to 6%. So it's better than a gilt, but still highly uncertain. There's still just two people winning these massive prizes, but they're so big now that the average return is good. Would you then buy premium bonds?
Well, I did the simulations this morning, actually, and I increased the top prize for the premium bonds to 1 billion. And I reran the simulations. And now the average return, the mean return, is around 24%, which sounds incredibly attractive.
It's juicy, Roman. It's juicy.
Guess what the median yield is?
Same as ever.
Yeah, 3.3%. So I think that's the problem. I don't feel lucky. It's like Clint Eastwood said, "Are you feeling lucky, punk?" Well, my reply as I was lying bleeding on the floor would be no. I don't feel lucky.
Well, I tell you, Roman, I'd have £50,000 in my name in premium bonds. I'd have £50,000 in my wife's name. I'd have £50,000 in both my kids' names if there was an average 24% return.
But you're not going to win it.
Yeah, and also this is so hypothetical. Like, the Treasury is not going to start paying out £1 billion prizes, are they?
No, because they would be taking the other side of the bet.
But I think it does raise an interesting point about the differences in psychology here. So you're saying that even if this average return, this mean return, is like stupidly high, you're still not going to touch it. Whereas other people would just be falling over themselves with a lottery like that. And you could make the case that both are being rational.
Well, I'd argue that you have to consider the probabilities as well. And, okay, the expected return is not what you're going to generate, probably. So that's why I think the median's so important, because it doesn't look at these outliers. It doesn't get swayed by these huge payoffs.
Do you know what I think's important? Position sizing. If you were a billionaire and there was this crazy premium bond payoff, of course you'd buy the maximum £50,000, right? It's a small part of your portfolio. Why wouldn't you take that stupendous expected value and mean return? But obviously, if you don't have much money, then yeah, you can't throw a huge amount of it into a gamble like this, even if the expected return is really high.
And that's what I really find pernicious about gambling itself, which is that usually the people who can least afford it are the ones who take part in the game. Now, in the case of premium bonds, that's not true. You have to have a certain amount of capital to invest it and make it worthwhile. But most people's stakes, I think, are quite small. They don't realise that you have to have a certain threshold of amount invested to get a reasonable chance of some kind of payoff. And as a kid who sat in my grandfather's Triumph as he went into the bookies in order to pay away his pension,
Oof.
I just feel quite bitter about people being exploited that way.
Yeah, I do too. I mean, I don't think premium bonds is the worst case. I mean, people are not going to lose their stake. But yeah, I hate actual gambling if it's done to excess where, you know, everyone's losing to the house in aggregate. But I have noticed that even on the PensionCraft community, which is generally people who are pretty well off and into investing, a lot of people do love premium bonds still.
Yeah, there was a thread about it recently, and my reply was, I'd rather have the certainty of a payoff from a gilt. And someone replied that I was a fun sponge. I couldn't believe it.
All right, so we've talked a lot about this spectrum between gambling and investing. I thought what might be good, Roman, is if we go through a few different kinds of these lottery ticket investments and think about where they might lie on that spectrum.
Yeah, that sounds good. And I think it's important how you use them. A common one that people think about with low probability high payoffs would be deeply out of the money call options, or maybe even deeply out of the money put options. Both have a similar payoff in the sense that it's a pretty big payoff, unlimited in the case of call options, limited by the downside in the case of put options. But the probability of receiving that payoff is low.
So what does the deep out of the money bit mean?
So remember that what a call option is the option, but not the obligation, to be able to buy something at a fixed price at a fixed point in the future. So let's say that there's a stock which is currently trading at 100. You think it's going to go up to 200. You could just buy the stock, but then you have to pay 100 today. Or you could buy a call option, which is deeply out of the money. You could buy it for pennies, where if it goes above 200, you make money 1-for-1 above that price. So the payoff is potentially absolutely huge, don't be fooled by the fact that it's an option. It is a leveraged trade. But there's a very high probability that you'll lose your whole stake, which was pennies, but that's a very high probability outcome.
So the deep out of the money bit means it's a long way away from the current price.
Yeah, the chance of a payoff is low because it's way away from where we are today.
So it sounds like a classic lottery ticket. How is this not just a gamble?
It's because of the way people use them. Now, if you've got a deeply out of the money put option, well, there you're betting on the price falling. And usually people buy these as insurance against their portfolio falling. So you don't buy them on their own. It's not a naked put option. You buy the put option and you own the underlying thing, so that if there is a big fall, it starts to reduce the size of the fall in absolute terms when you add the two together, the put option and the underlying thing.
So that makes sense that it's kind of a component of your investment portfolio that maybe a professional fund manager might use to manage their risk. And as we said earlier, one of the things that might characterize an investment is a transfer of risk. However, not everyone's using them like that, are they? Some investors are basically gambling using options.
Yeah, if you look at the meme stock craze, the way people expressed their views about those meme stocks was usually as out of the money call options on these pretty toxic companies which were unlikely to pay out. But because of this kind of mass movement, the large numbers of people on Reddit who bought the stock, essentially that fabricated the rally itself.
So it's a key point, isn't it? The distinction between investing and gambling might not even be in the instrument itself. It might be on how you're using it. And I think we mentioned venture capital earlier. Maybe that's similar. If you're just taking a bet on one small early stage startup in isolation, that's pretty close to gambling, I would think, where the payoff could be huge, but most likely that company's not going to make it. But if you're running a fund and you're investing in, dozens of these companies, hundreds maybe, then the more diversification you have, yeah, that's more like investing, isn't it? And of course, there could be an edge there, which is the other thing we said might characterize something as investing.
Yeah, if you believe those venture capital fund managers can look a CEO in the eye, a founder in the eye, and say, I can tell you are going to have a successful company, or at least to have slightly better odds and chance of being able to do that, well, yeah, there would be an edge in that case. And of course, they do have an informational advantage because they know about the business plan. They work intimately with the founders themselves to try and ensure that they have a higher probability of success. So that does shift the odds in favor of VC. But again, this is not something which I would seriously consider as part of my portfolio, certainly not my core portfolio.
But it seems to be that when people get rich enough, this is often where they focus their time, isn't it?
It is, and I think part of that is also the societal aspect, which is that you create these innovative company. You provide capital to people who've got ideas, who essentially come up with exciting, transformative things. And who wouldn't want to be engaged with that? I mean, what better use of your capital could there be than to ensure that these companies are successful, or at least some of them are successful, and to play a part in that success?
Yeah, I think in a sense, it's a noble use of capitalism, isn't it? Even if it goes wrong for you individually. Like if you lose money on the bet, but the world gets a cure for cancer or a new chip factory, if you lose money, that's sad for you, but kind of good for humanity. But if you lose money and all we got was a sort of dog meme coin, well, that's just sad, isn't it? It's not good for anyone. But I suppose your version of this, Roman, what you mentioned earlier, is you kind of like microcap stocks in a way. You just don't want to put too much money at risk on them.
No, and I do try to shift the odds in my favour. I do filter them very, very carefully, looking for ones which have the attributes which I'm after. Reasonable profit growth, reasonable value, people aren't overpaying for it, and of course momentum. There has to be a sign that it's actually improving. I'm not that patient, and I haven't got that many years left, unfortunately. But as long as you have those three components in place, I think you've got reasonable odds of choosing stocks which will outperform. But would I place a large amount of money onto it? No, I wouldn't, and I don't. So it's fun, and I like the game, but I just think that the chance of a big payoff is pretty low, even with the amounts I invest, which aren't huge, to be fair.
But it is the closest you come personally to gambling, right?
Oh, it is. It is. And it is, again, part of the fund portfolio. So I'm very clear about where I allocate this capital. My core is sacrosanct. That's for the high probability, reasonable returns for a long period of time. If I want to do the gambling stuff, there's a very clear place for it, and also a very clear size as a proportion of my wealth.
There are some types of stock in the microcap space which I think have even more of that kind of gambling flavor to them. And here I'm thinking of things like a junior mining company where it may or may not find an oil deposit. If it does, you might be quids in. But if it doesn't, as is most likely, that stock's probably going to be worthless. Another might be pharmaceutical companies, right? Where their whole company is staked on their miracle drug, proving its efficacy in trials. And it's almost a binary bet, right? Does it work or doesn't it work?
And sometimes it's technology. Are you going to buy a company which is researching nuclear fusion? Well, if they're the ones that come up with the magic recipe for fusion, that is unlimited in terms of the upside. Or maybe quantum computing. That's another branch of research which really could transform society in terms of doing hugely parallel processing of computations.
Didn't you say they were already running the premium bonds on a quantum computer? How is that necessary?
But all they're doing is counting photons, right? You just want to generate random numbers. Quantum computing is perhaps overselling it slightly.
Makes good copy, doesn't it?
Absolutely. Quantum, yeah, well, kind of. And I think the danger with those companies is that people often feel they have an edge when they don't. So, for example, I'm a physicist, I'm a nerd, so I think I kind of understand quantum computing or maybe fusion. So I could assess whether these companies are going to be successful. Whereas in reality, I just don't think I have that edge at all.
I would be surprised if any retail investor could really assess whether some injection is going to help people lose weight. Some work, some don't, right?
That's right.
Unless you've got inside information. And even then, you don't know. The companies don't know themselves, really.
Yeah, so be wary of thinking that you've got that edge when in reality you probably don't. That's not to say don't play the game. I don't think that's true at all. Play the game, but just size your bets accordingly.
Well, we talked a lot about stocks there, but Roman, your heart, it lies in bonds. It lies in debt, doesn't it? So are there kind of equivalents in the debt markets where there's this like lottery ticket style payoff?
Yeah, we've got distressed debt funds. And I'd be careful there because remember the people who play in this game are the ones which have a lot of capital. Now imagine that there's a company which is on the verge of bankruptcy and you're a hedge fund. Well, you can buy up a large proportion of that company's debt and then suddenly you've got a seat at the table in the negotiations. So in a sense, you can pretty much force the company's hand and you may come out with favourable terms which favour you, but maybe not the rest of the investors. If that's the case, well, you might feel as if you're buying in alongside these distressed debt investors and you're going to benefit. It may be the case that that's not true. So I don't think this is a game most people can win if they're retail investors.
So let's just unpick the dynamic here. So it's a company who's borrowed a lot of money. They've fallen on hard times. They might not pay that money back. And so their debt is now trading at, 30 cents on the dollar or something, because there's a big chance that they go bankrupt and can't pay back the money, or at least not enough of it.
That's right. So in a sense, this is a binary outcome because they either go bust or they don't. But there are various ways that they can restructure the debt so that that's not such a problem. They could extend the debt so that the maturity is longer. They could have a haircut so that you only get 70 cents in the dollar back.
And there's also often a bun fight between different holders of the distressed debt, right? Like who's going to have which asset collateralized against their debt. Often it's the case it ends up in court, right? And someone gets screwed and someone gets made whole. And you're like, well, how is this how it all works? But apparently that is how it works.
So again, it's always good to know what game you're playing and what your odds are of success and whether it's skewed in your favor or not. Now, in this case, I'd say it's probably not, certainly from an informational point of view. You're not at the negotiating table, so you're not really going to know what's going on.
Another kind of investment I've been reading quite a lot about recently is catastrophe insurance. where it again has this kind of dynamic where there's a low probability event which is hugely impactful. But in a way, it's like an inverse lottery, because if you sell catastrophe insurance, cat bonds as I think they're called, you're collecting a small premium each year to insure against this disaster. But then occasionally the volcano does go off and you lose a huge amount of money. It's like an inverse lottery, right?
Yeah, whenever you're getting a good return on an investment, you should always consider what the risks are which you're generating that return, because they will materialize at some point. That's the whole point of risk and return, the trade-off. Now, in this case, what's happening is that insurance companies are laying off their risk in the form of these bonds. But if you're taking that risk, well, are you comfortable or fully knowledgeable about the odds of that payoff, which is that you end up losing a lot of your capital? And again, this is something that would kind of put me off the asset class itself. You know, there's the illiquidity, or also the question of what am I buying here and why am I buying it? And who's selling it to me and why are they selling it to me?
But Romin, I really want to make the point here that you're being highly inconsistent. You said earlier what you care about is the median. Like, the median of this is you're going to be just fine, earning your nice high yield every year. Why are you worrying about these like unlucky events? You're just going to get average luck, Romin.
Yeah, as long as I could work out what the odds were. But in this case, it's kind of difficult to know. What's the chance that a tornado is going to wipe out a large section of the Midwest? I don't really think I could calculate that.
Don't you think also that people are much more drawn to a sort of lottery upside than a lottery downside? There's a reason there's not loads of products like this.
Yes, and it makes people overpay for it, which again comes back to why this is a marketer's dream, because it kind of tickles your gambling fancy. And the dynamic of these catastrophe bonds is a little bit like selling options, which is the other side of that trade, where what you're doing is selling out of the money call option, say, where you're betting that the price is not going to go up a lot. In return, you can bag the premium and generate an income, but there's always the risk that there is a huge surge in the stock price and you end up having unlimited downside. So always there's a trade-off. What's the risk? What's the return? And do you want to risk a potentially unlimited downside in order to receive this chunky income?
It struck me as we're talking about all this, Romin, that if we accept the premise that there are these lottery ticket style investments, what might be a gamble in isolation could become a kind of sensible investment if it's part of a portfolio, if it's diversified because you hold enough of them. Like one individual premium bond feels much more like a gamble than the full £50,000 worth, where it tends towards the typical return.
And again, this comes back to having money that you can afford to lose. If you are in the case where you've got an excess of capital or where your core is invested in the boring stuff, yeah, you can have a fun portfolio. And the more money you've got in the core, the more you can have in the fun. So the amount of fun you can have is directly proportional to the size of the boring investments, I'd say, if you are going to be rational about it.
Yeah. But it's also the case that when we started recording this, I was kind of thinking of it's the investment itself that matters. It's either a gamble or an investment or somewhere in between, depending on what it is. It's more like how you use it, right? What role is it playing in your portfolio? It's all about asset allocation.
And this is what I mean by being clear about which game you're playing. Is this just a fun thing, or are you kind of betting your family's future on this? And those are vastly different games.
But the fact we've had to make this episode, Romin, tells me something, which is that people love lotteries. Why do you think that is? Why do people buy lottery tickets?
I think we're just geared for excitement, or at least some of us are, where you think, oh, I could win this amount of money and it's exciting, and your heart races when you place the bet, and then when you check whether you've won the premium bond or whether your call option's paid out. And people love the adrenaline rush.
Is that what you were referring to right at the start of this episode when you said there's a kind of physiological effect, which is the red flag for you?
Yeah, I often think that if you get excited when you're doing something to do with your portfolio, that is an immediate red flag that tells you you're doing it wrong. It shouldn't be exciting. It should be boring. And if it isn't boring, I think there's a problem, at least for the core.
One of the reasons I've heard for why humans might like lottery tickets is that we overweight tiny probabilities. And fundamentally, that might just be because we're bad at maths intuitively. If you ask people the difference between a 1 in a million chance and a 1 in a billion chance, they go, I don't know. It's not going to happen, is it? It's unlikely. But there's a huge difference between 1 in a million and 1 in a billion. There's vastly different chances of success there.
I think maybe the problem's the word, because million and billion sound very similar. They're the same length word. Maybe we should say 1,000 million, because that expresses the number much better.
Yeah.
And we don't usually live with probabilities that are that low day to day, because why would we?
Yeah, you can't spend your time thinking about 1 in a million things because there's so many of those things to think about. So we're not intuitively able to grasp it, I think. You need a spreadsheet.
Or a Monte Carlo simulation. I think that's why Monte Carlo is so useful. You can look at these outcomes and really get a feeling for, if I did this for ages, what's the chance of winning? Things that we just can't reason out ourselves. It's similar to AI. If you ask it a numerical question, it often generates a Python script to work out what the actual numbers are, because verbal reasoning just doesn't work. It falls over.
Yeah. I think we're not born brilliant mathematicians, are we? We're born storytellers. Maybe that's another point, that a boring index fund getting you 7% return each year for 40 years is not going to make great dinner party conversation. Whereas going, I bought a microcap for 2p and it's now worth £100. That's going to get people's attention.
Yeah, imagine trying to create a YouTube channel where you're trying to convince people that index funds are going to work. That would be crazy.
But people have done it. I mean, that's a lottery ticket in itself, isn't it? Building a successful YouTube channel based on promoting index funds. Some people win, though. It could be you.
But I still remember one of our friends saying, so what? You just tell people to invest in an index fund. What else is there to say?
Well, we've made hundreds of episodes, so I don't know. But we've made it work somehow.
So maybe FOMO has encouraged you to take more risk than you're really comfortable with. Well, this is something you could discuss with our other members of the community at PensionCraft. Just go to pensioncraft.com/membership to learn more.
Okay, today's dumb question of the week. Are boring stocks better?
Well, this is called the low volatility anomaly, and it's an incredibly robust result, which is that if you go for companies which are the boring ones, the ones which have low volatility, which have low beta, they tend to move less than the overall market, they outperform, which is very odd on the face of it, because these are the companies which never attract attention.
And if you believe that, it does kind of break the rule that risk and return go together in investing. This is a case where, well, not always.
And what's interesting is that the most convincing explanation of why it happens is to do with the topic of today's podcast, which is that most people, instead of leveraging up the boring stocks to generate high returns, which is what the capital asset pricing model suggests you should do, well, they can't do that. So what they end up doing is buying these lottery ticket payoff companies, and that pushes up the price of those companies and reduces their long-term return. So it all comes back to the way that we're wired to love these low probability, massive payoffs.
And the low volatility anomaly is kind of exploiting the fact that humans are biased towards lottery tickets. And people have obviously packaged this up into funds. You can buy min-vol funds, and there are various strategies that exploit this, typically by measuring the volatility of companies over a certain time and going long the low vol ones and possibly short the higher volatility stocks. And the backtests show that should outperform, at least on a risk-adjusted basis. But, like with all these things, it goes through long periods of underperformance, of which we are in right now. It doesn't like bull markets, does it?
No, that's right. And it is something that's difficult to stick with as a result because of those periods of underperformance. You've just got to have faith that it's going to come back and start to work again. So, for example, if we look at MSCI minimum volatility, which is an index created by the index company MSCI, over the last 3 years, 5 years, 10 years, it's massively underperformed its parent index, which is MSCI World, which has just developed stocks, because the US has had just an incredible stock rally, and it's been the volatile, growthy names which have done very well. And even if you go all the way back to 1988, it's underperformed very slightly relative to MSCI World. In risk-adjusted terms, it's done very well, of course, because by definition, it buys things which are low volatility.
Yeah, it's a really interesting factor. And it does have quite a lot of overlap with other factors when you look at these funds. I've seen some people argue that the minimum volatility effect can kind of be explained by the fact that it overweights to quality a little bit and things like that.
Yeah, with these MSCI fact sheets, it's great. You can look at the factor weightings for any index. And looking at this one, obviously it's overweight low volatility, but also yield, because obviously it buys higher dividend paying companies. Also quality, which is interesting, and value as well would be another overweight. But of course, negative momentum at the moment because it's just not working in this kind of environment. And this is what put me off these minimum volatility funds. I actually bought one, I think, going into a little market sell-off, and it underperformed on the upside and the downside.
A learning experience.
It was, yeah.
But I know that some researchers look at Warren Buffett's career and say that a lot of his outperformance came from exploiting, either knowingly or just accidentally, this low volatility anomaly. Historically, he tended to buy low beta stocks, which were high in quality. He did it with leverage implicitly and was able to generate phenomenal returns, far above the index.
I think that's true of some of his bets. But we've got to remember that he also bought stocks like Apple later on in his career, which has performed very well. But that would never be described as a low volatility, low beta stock, quite the opposite.
It was a mature stock at the time he bought it, though.
Yeah, I mean, he didn't buy it when it was really struggling.
Presumably the tide will turn again at some point, and min-vol will be a winning strategy again, if this bull market ever ends.
Yeah, it would be surprising if it never came to the fore ever again. I think there will come a time when it is considered better and when it does perform better. But as a style of investing, I've never been that keen on low volatility.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.